Welcome to Exchange Traded Fridays, brought to you by ETF.com. I'm your host, Paul Curcio, managing editor of ETF.com, and joining me is ETF.com's talented team of writers and editors. We have senior ETF analyst Sumit Roy, contributing editor Ron Day, financial reporter DJ Shaw, and financial news editor David Toney. So we have a lot to cover. Let's dive right in. Earlier this week, the Wall Street Journal reported that President Trump is expected to sign an executive order that would open up retirement accounts to private market investments like private equity, venture capital, real estate, and hedge funds. Now, Ron, you wrote about this and pointed out that ETFs could be the preferred instrument to expose 401ks to private assets. So, in a nutshell, how would that work?
Well, there's already like a vehicle that's been created, and that's the State Street Apollo ETF with the ticker PRIV. So, researching the story a little bit yesterday, I kind of got a sense, and also talking this over a little bit with David, trying to find some direction for the story. It does look like this is something that's been speculated about for a while, getting private equity into 401ks. How do you do it? Well, through funds, through ETFs that 401k issuers will sell and plan designers will, make part of their offerings. So now that we do have this, so it looks like maybe some of those firms kind of got ahead of the curve a little bit, became early movers, and now this legislation from President Trump looks like it's going to be signed. So there's the vehicle, PRIV.
Well, I hate to interrupt you, and I don't mean to correct you, but if it's an executive order, we can't call it legislation.
All right. I stand corrected. So the rule change, kind of as we're talking about this, it does seem like a norm busting type of thing, because private equity doesn't make you think of, retirement money. It doesn't make you like 401ks you think of as being reliable sources.
Well, yeah, it's the kind of thing that you think of, high rollers, that they have a lot of excess capital that they can risk, and they have the patience to be able to wait for these risks, for these investments to pay off.
And these are generally, I think if you're the type of person, maybe it sounds funny to say, you live scared as a retiree, but I do think there's a little bit of a fear when it comes to your nest egg. It's hard to be comfortable when you're not working. So to think about putting retirement and lifetimes of savings, putting, some of your money into that, it just seems to be contrary to the idea of Vanguard, retirement account. But Vanguard's jumping in too with a plan with Blackstone and Wellington.
So that leads me to another question. So how are the ETF issuers adapting? It seems like private assets have been creeping into the ETF space. We've been talking about it over the past, talking about it and writing about it more specifically over the past month or so, or 2 months. So you're saying Vanguard is one of the companies that's already making moves. What kind of moves are they making, and how would that impact ETF investors in terms of being able to incorporate private assets into their investments?
Vanguard has not created an ETF or anything like that with private equity, though it does look like BlackRock is kind of making those kinds of moves. There's a story today about how Larry Fink, I believe it was on their earnings call the other day, did say that they are planning to start offering private equity in their target date retirement funds. So again, I don't know how they make these things safe, reliable, income generating. I'm not too sure how they're going to do that. But to answer your question, I did see State Street has another one planned with Apollo. Now, this current ETF, PRIV, is not, it's kind of been it hasn't been like setting the world on fire. There have been massive slugs of inflows over just like the past 2 weeks or something. It's doubled but not on price gains, just on inflows. Probably people seeing this thing coming and saying, let's jump in.
So let's put this to the panel. How do we feel about this? Is this a good idea to add private assets into retirement accounts to ETFs in general and making it open to retail investors who normally wouldn't have access? Who wants to start?
I feel like I see 2 points of view. I think, it could be good if someone wants to really diversify their retirement portfolio and open it up if these strategies are really high return. These are strategies that were usually only available to bigger institutions. But I also see the flip side of the argument where people could be skeptical. They could be worried about liquidity issues or high fees or the general risk of just putting these more opaque and harder to value assets into retirement accounts, which are meant to be long term and pretty safe. And I just always have a bone to pick with private equity. I just feel like, if you put private equity into the same sentence with, just anything that I've liked, it's probably going to go downhill. I mean, you can look at what happened to Toys R Us.
Yeah, I mean, it's not just private equity, it's also venture capital is another avenue, as well as real estate. And real estate, is a head scratcher because real estate is something that's easily accessible to anybody. Any kind of investor wants to invest in real estate. They can directly or indirectly through REITs, trusts. Yeah. So, to me, what you say, DJ, really stands out to me is I have a question of valuation is a really good question, and liquidity and what that means for retail investors. How long are they in these, and what percentage of their portfolio or the fund that they're invested in is comprised of this? How would it all work?
And I,
Um,
I feel like, even if it is something that's, allowed, are issuers actually going to allow it? Just because it's legal
right.
now, does it really
Just
mean?
because you can doesn't mean you should or
Yeah.
will. Yeah. The old Jurassic Park conundrum. David, you had something to say.
Yeah, I can also see both sides of it for retail investors. On the one hand, your 401k assets are ideally going to be held for a long time. And so that would, allow the benefits of private equity to compound the diversification benefits and the returns, hopefully. But we also know that retail investors are, subject to, the emotions that we all feel when it comes to trading. And there's, some kind of significant drawdown and an investor decides to offload that fund because the fear is overriding their rationality, then they may not enjoy all those benefits that they could have if they held it for a longer period of time.
Well, the greed also, you start thinking private equity or something like that, your greed overwhelms your, rationality. Everybody knows a retiree or near retiree who decided to risk their nest egg and maybe had to work another 10 years. I mean, these kinds of things really happen. We have a columnist, Alan Roth, who's always kind of cautioning about, safety is your, in your, once you with a nest egg. And what does he say? Diversification is the only free lunch in investing or something like that. But so I don't know. I just think people can get a little nuts with something like this. And sometimes, we can all be our own worst enemies when greed kind of starts creeping in.
So proceed with caution it seems to be the overwhelming message coming out of the group so far.
Flirt, marry, kill. I say kill.
Yeah, sure. Well, we haven't gotten to that yet, but yeah, our
Yeah.
little game of flirt, marry, or kill. Yeah, I don't. It sounds like maybe flirt. I don't know. Me, I'm not for it. Sumit, did you have any thoughts on this? Because maybe you have the opposing point of view. Maybe you're all for it.
I wouldn't say I'm all for it. I think I echo what everyone's been saying. We got to wait and see how this plays out. It's going to take time to see what type of funds are out there. Is it going to be target date funds that have, a small sleeve of private assets? Is it going to be more dedicated funds, things like that? And then we have to see over time what the performance is, what the diversification benefits are from these products. It's still way too early, I think, to make a determination of whether this is good or bad. But I think definitely we have to be cautious because this is completely new ground, and this is a very important thing, people's retirement. We don't want to necessarily have them taking too much risk. The current status quo of, stocks and bonds publicly traded has been working pretty well. Obviously, the stock market has delivered phenomenal returns.
60-40.
Yeah, exactly. So it remains to be seen how much actual benefit there is by including private assets into that mix. Our investors is ultimately going to end up taking more risk than they need for little benefit. Who knows, right? It's just way too early to say. And in the ETF world, I think we also have to separate the mutual fund world, which currently dominates 401ks, from the ETF world, which is more in taxable accounts and IRAs and things like that. So these are two different things. Obviously, ETFs, you need the daily liquidity. So it's kind of a tougher hill to climb for ETFs to include private assets. We've seen some, private asset star tanner ETFs, like Ron mentioned, PRIV. We have the private credit those out there now as well. But it'll be interesting to see, what they could do with the mutual fund structure, because conceivably it'd be easier to put private assets into 401ks where you don't necessarily need the daily liquidity. So I'm in wait and see mode, just gonna watch and see what happens. But yeah, I wouldn't necessarily be jumping with both feet into this.
Excellent point on the mutual funds as well. Thanks for that. And one last point I'd like to make is, let's not hold our breaths, because President Trump has been known to change his mind and not do what he says he's going to do. So who knows if this will even happen. But let's move on to another alternative investment that's been red hot lately. Bitcoin recently reached an all-time high above 120K, which has basically doubled from a year ago. And the next most popular cryptocurrency, Ethereum, is also on a hot streak, as spot Ethereum ETFs recently had their biggest day of inflows ever. Meanwhile, the US dollar index is at a more than 3-year low. So what is driving this turnaround, and how can ETF investors position themselves going into the second half?
I'll take a chop at that.
All right, Ron, go for it.
And let's point out that we have the 1-year anniversary of Ethereum ETF, spot Ethereum ETFs. They hit the market July 23rd last year and have pulled in $5.5 billion in assets. So really trailing Bitcoin. But I mean, Bitcoin is much larger itself as a market capitalization. But Ethereum has doubled in just the past 3 months. So that's really not bad, and it's still on a tear. And it's being pushed along by the whole stablecoin legislation that I believe may be signed this week. A lot of, I guess it's like the Ethereum, the Ether token or stablecoins are traded. And, you guys can tell me if I'm like getting on to thin ice right here, because, being a writer, not a trader, is these are two different things. But Ethereum, it does have a link to the stablecoin phenomena, the stablecoin legislation. And, it's up again today. Oh, and we should point out that this is crypto week. So crypto week is really kind of shining a light on these cryptocurrency ETFs.
Also worth noting that...
Hang on, Sumit, go ahead.
Yeah, also worth noting that Ether has lagged Bitcoin pretty significantly this year. It's only up 2% year to date versus 27% for Bitcoin. So some of this might be a catch-up trade, but Ron also makes a good point. It also has to do with the stable coin mania, you could even call it. We saw what happened with Circle Internet Group after the IPO. It went from 30 to, I think, 280 or something in like 2 weeks. Crazy move on the back of all the hype about stable coins. And then we saw Coinbase stock also rip higher, bottomed out, I think, around 150 in April, and then now it's around 400. Both Circle and Coinbase collaborate on that USDC stablecoin. So they benefited from the hype around that. But as Ron also mentioned, the majority of stablecoins that are out there are issued on the Ethereum blockchain. So conceivably, you would think Ethereum's going to benefit from all the enthusiasm about stablecoins, but it hasn't been the case up until just this past week. Ether has been lagging significantly. I mean, you just go back to early July and it was down 20% year to date. So we really just saw it head into the green over the past couple of weeks. It went from minus 20% to plus 2%. So
It's still at
craziness.
its
It's been
all-time
in the
high.
doldrums for a while. Ether's just been lagging. So
Yeah.
this is really coming out of left field. David,
Yeah.
what was your point?
Yeah, I was going to make the same point about the performance lag, and I'm looking at a long-term chart of the iShares Ethereum Trust, ETHA. I'm seeing that it's just kind of getting back to the levels where it first debuted about a year ago. And so I agree with everyone that Ethereum has probably lagged because there's kind of been a lack of a story behind it, whereas Bitcoin has seen, a lot of momentum from the story of, rising deficits and stuff, and the idea that it acts as a store of value. And Ethereum really hasn't had that kind of story until now with the stable coins. And I can also see early investors in ETHA are kind of getting back to break even right now, that the momentum could continue if it kind of breaks out above those early prices.
Its all-time high is 4,800 and it's at 34. So it's got a long way to go.
In the
That's
meantime,
impressive.
the first time I came across Ether, it was like around $35 a coin. So it's come a really long way. If only.
You didn't
Anyway,
buy pizza with it, did you?
no, I didn't have any. No, I was like, what the hell is this? No, really, really excellent point, David. I also think that, that definitely is an aspect of it, that Ethereum seems to be the wallflower at the crypto dance, and it's been overlooked for a long time. And now folks are starting to look for alternatives to alternatives, because Bitcoin, does get a lot of ink, or not
Pixels?
pixels. Thank you. That's the word I was looking for. Okay. So moving on to our third subject of the day, we've seen reports this week that President Trump was ready to dismiss Federal Reserve Chair Jerome Powell, and those reports appeared to be premature. But the prospect of a sudden leadership change at the central bank still looms over markets and the economy. So, what would such a change mean for ETF investors?
Does
Well,
it
I
mean we'll
mean,
get the Federal Reserve
Sumit,
building? Oh, you go ahead. Sorry.
go ahead, Sumit. Sumit
I
got
mean,
in there first.
conceivably, if Powell got fired or something like that, that would be troubling for financial markets. Obviously, that would hurt the credibility of the Federal Reserve and what it means for inflation. People might start to predict inflation would be higher because the Fed is kind of beholden to the president. They might keep interest rates lower than they need to be. But we haven't obviously seen that kind of turmoil in financial markets yet, probably because Powell is still there, even though Trump keeps threatening him. Nothing has really changed. The status quo remains. But if we ever did see, Powell get fired, again, that doesn't mean he's immediately going to leave, because maybe the Supreme Court could get involved and, stop that from happening. But let's say Powell did end up leaving because of Trump, theoretically, you would expect some kind of turmoil in the financial markets. You see stocks drop. You would see potentially long-term interest rates rise because inflation would be higher going forward, things like that. And you'd want
Which
to
would be bad
gravitate
for the
toward.
financial sector too, because with rates going lower, margins drop for them.
It would be bad for the entire stock market,
Everybody.
higher interest
Yeah.
rates, right?
Yeah,
Yeah,
everybody.
and it'd probably be good for, safe havens like gold. Probably you'd want to gravitate towards very short-term bonds, T-bills, things like that, like S-Gov, like we've talked about many times. So yeah, I mean, it would be troubling, but yeah, so far we haven't seen it yet.
Ron, you were going to say?
Oh, just it's kind of it's hard not to scratch your head that about this whole thing is being pinned on the Federal Reserve buildings remodeling. You know,
Yeah,
that's the thing. I mean,
it
does
is
it mean
laughable.
is Kevin Warsh, does he have an engineering degree? Is he going to push the Federal Reserve's renovation building? Is he going to buy lower cost IKEA furniture or something like that? I don't know. Pass the savings along.
Well, and also let's not forget that, the FOMC is comprised of 12 people, aside from the chair, and they vote on this. So a change at the head of the FOMC and the chair of the Federal Reserve, doesn't necessarily predict the outcome that the president may or may not want. So let's keep that in mind. David.
I just wanted to reiterate something I heard mentioned on CNBC yesterday by a guest, which is the story may be more about the lack of a reaction in the market, because I think we all think that the odds of Powell being replaced are 50-50, if not greater, and yet the market's at all-time highs right now. So the market seems to be saying that it's indifferent to who the Fed chair is, in my opinion.
As they say, it's baked in.
But why would the market be indifferent? Is it because they know who's really pulling the strings? Is it, like, why would there be indifference? I'm not to dispute what you're saying, Dave. I hear you loud and clear. I just like why.
If I had to guess, fiscal spending maybe is going to continue to support the economy regardless of what the Fed does. Not as
Here's what I would
great
say,
as
David.
people think.
Maybe the market isn't so much indifferent as it is in wait and see mode. That the president makes these pronouncements on a regular basis and then changes his mind 10 minutes later. And so I don't think it's indifference as so much as it is like, I'll believe it when it happens. That's my view. All right.
Yeah.
So last segment. Here we go. A little fun little game I like to call Flirt, Marry, or Kill. So I throw out 3 different ETFs, and our panel tells me what they would do with it. Would they flirt with it? Would they marry it? Or would they kill it? These are all ETFs that we've written about this week and maybe even discussed today. So here we go. Let's start with the Granite Shares 2X Long NVDA Daily ETF, ticker NVDL, which Sumit wrote about earlier this week. Sumit, what would you do with that one?
I would flirt with it. It's good for aggressive short-term traders. Definitely not a buy and hold type of investment.
Ron,
Kill.
DJ.
I'm gonna go with Flirt for the same reasons as Sumit. It's up. This fund is up over the past 3 months, 152%, or over 152%. It's doing well.
David.
Totally agree. Could be a good trading vehicle, but wouldn't want to hold it long term.
So you're a flirt?
Yes.
I'm a kill. I'm with Ron. My reasons to kill are because basically, what do I need to leverage it for? There's too much volatility in that. I'd rather just invest in Nvidia directly because it's been a winner.
Mm.
So we have 3 flirts and 2 kills. So Flirt is the winner for NVDL. All right, the SPDR SSGA Apollo IG Public and Private Credit ETF, or otherwise known as PRIV, which Ron wrote about in his story about adding private assets. That's the ETF we were talking about earlier. So Ron, what would you do with PRIV? Would you flirt, marry, or kill it?
Well, I would think about having one of those marriages where you could like have like
What is it, like an open marriage? What are you, a
yeah,
teen?
something like that. Yes, yes, a thruple. I would be a thruple. I don't
Okay.
know. I find it like really. I mean, just a little bit.
Married with a hall pass. Okay. I'm gonna leave those analogies alone. David, what would you do with that one?
I might flirt with that one as well. Like we said earlier, it's so new. We just don't really know what's going to happen. And, there could easily be a speculative mania in private assets as well. So might want to trade it.
All right, so let me just double back to Ron for a second. So it's marry or flirt?
No, I'm going marry.
Okay, it is married. Married
Yeah.
with a hall pass. I got it. Okay.
Yes.
DJ, what would you do with PRIV?
Man, I'm gonna have to go with Kill. I don't think I'm confident in that ETF yet. I don't know. I'm just gonna have to stay away from it for now.
All right, all right. And Sumit?
I'm a flirt on that one. It's a groundbreaking ETF, could be revolutionary, has, a lot of new mechanics that we've never seen in ETFs, but it's way too early to say whether it's going to be successful or not.
I'm a kill. As I said earlier, I have a problem with valuation and liquidity. So I'm very cautious about these things. I wouldn't go near it. So we have a mixed response on this. We have 2 flirts, 2 kills, and 1 marry. So I guess marry wins the day on that by default. All right, last one. The Financial Select Sectors SPDR Fund, XLF, covering the financials. David, what would you do with that one?
I'd say kill. There's so many other more interesting ETFs, in my opinion, that I'd rather hold or trade.
Sumit.
Another Flirt for me. Great low cost ETF, broad exposure to the financial sector. Great for people who want that. I don't know it personally, but I think it's a great product.
DJ.
Maybe in previous years I would marry, but I think I'll probably say Flirt. It's had a bumpy ride lately with mixed earnings and CPI data. So I'll just flirt with it, keep it around.
And Ron.
Kill.
Ooh.
Not just not interested. Just strictly from that point of view.
I would say Flirt because you never count out the financials. They always have a way to make money, even in the worst of economies. And so I'd stay interested. So Flirt's hold the day there, beating 2 kills on XLF. And that brings us to an end of our episode today. So thanks to all our listeners for streaming or downloading Exchange Traded Fridays to your devices. Remember, if you haven't already, please like, subscribe, or follow Exchange Traded Fridays wherever you get your podcasts. If you have a question, you just want to share your thoughts, join the conversation on X, formerly known as Twitter, where our handle is @ETFCOF. See you next Friday.